Hi, thank you. So I'll just kind of dive right into it here. As I mentioned, I'm going to be looking at the, oh, no, just stick with the, thank you, Rose. What I'm going to do here is just a little bit of a brief accounting, pun intended, of the financial thread in ESG ratings. So it'll be a bit of a high-level survey of investor use cases, highlighting where and how ESG is linked to investment and financial metrics, decision hygiene, and decision making. But I'm going to start off with, and I like to plant the flag here a little bit, that ESG ratings were designed with the primary users of financial reporting in mind. That's the financial and the capital markets. ESG is an analytical tool suite, one among others used by capital markets and financial institutions. Thanks. The next slide, please. So this is one of my favorite movies is Avatar, which is, if you remember, is a film essentially about mining and community relations. I use this slide often to introduce my conflict risk assessments, but I think it has application here to the wider ESG space, which tries to qualify and attempts to quantify intangibles like the social license to operate that Miguel is going to be speaking to later. And that is summed up here by looking at, if you remember the concluding sequences in Avatar, and this is one of them, a shot from it, that are currently echoed around the world today in Peru, in the Sahel, in the DRC, and the consequent production, operational, and financial impairments that happen. What is noted here as bad quarterly statements. So where I'm going to now move off is to say there is four main categories of investors which hold the ownership of today's publicly listed companies. Institutional investors, and that's who I'll be focusing on, public sector owners, private corporations, and strategic individual investors. Now, institutional investors are by far the largest group, and they hold over 40% of global market capital. They are profit maximizing intermediaries. They invest on behalf of mutual funds, pension funds, and insurance companies. And that's the long-term stable capital that companies are thirsting for. US-based institutional investors account for about 2/3 of global institutional investor holdings, and they dominate the ownership of listed companies in the United States, in the UK, and in Canada. The average combined holdings of these companies, 10 largest institutional investors on a company basis, equals about 30% of their total equity capital. So now I want to try to draw the line into ESG. According to the 2020 Global Sustainable Investment Review, sustainable investing assets reached $35.3 trillion globally at the start of 2020, the beginning of the pandemic. And that's been a 15% increase from 2018. Approximately 36% of total assets under management are now sustainably linked or have it in their title. And this is also interesting because it's known as a tipping point. Similarly, the number of signatories to the United Nations Principles for Responsible Investment, PRI, is that institutional investors committed to ESG-oriented investment decisions has increased from 734 in 2010 to over 3,000 in 2020. The next slide, please. So a quick note on the abbreviation here. Where is the financial is what I'm using, not the traditional one. So ESG issues for investment purposes are constructed usually as a proxy for mispriced risks. Issues like sustainable business models that Sarah's alluded to and has already been covered, social license to operate coming down the pipe, or as I started with in the opening slide, conflict. Now, MSCI, another one of the notable ESG raters, answers this question using three parts. So the first part is you'll see ESG linked to finance in cash flow performance, the investment metric on its own. We can follow mining company cash flows, and there is a correlation to ESG, and high ESG ratings are correlated with stronger cash flows. The relationship between valuations and better ESG ratings is sort of the second point there. And that's the underlying hypothesis of ESG investing in the first place. Essentially and eventually, you get a lower weighted average cost of capital. That's the WACC in the bottom right-hand corner. But this relies on what is known in financial markets as net present value or discount cash flow models. And these models are showing out to be insufficient when they're confronted with things like uncertainty and irreversibility, which are also inside standardized statistical distributions. So something that ESG risk raters approach differently as well, how they manipulate their statistics. And then the third point here is idiosyncratic risks, and this is really sort of the wrench in the system. These require more trained analysts to further unpack an understanding of context, a deeper analytical foundation. The old adage that if all you have is a hammer, then everything looks like a nail comes to mind here. How permanent are the effects of these idiosyncratic risks? And I'm thinking here, usually it's events, something that plagues the industry, impacts, costs. Are they recurring? Is it something that you have to replace a washed out road every year or sabotage mine access points? Does it require replacement or substitution? ESG ratings have been transitioning away from their original objective, started in the 90s, of do no harm. They went through a phase between into the financial crisis and into the 2010s of data proliferation. You know, you just see reports of everything and anything going in, sort of the kitchen sink. And now it's become more about signaling the intentions and performance. Are companies talking or walking? Next slide, please. One of the loudest critiques of ESG ratings is the difference in ratings on the same company. The traditional WTF might apply here, and that's commonly I've heard as well. And that's what this slide tries to show you here. Company rating differences by industry from 3 different rating agencies: Thomson Reuters, I think it's now Refinitiv, Robeco Sam, which is now S&P, and Sustainalytics, which is now part of Morningstar. And as I mentioned, where I was not too long ago. The middle line on each of these 3 graphs is the rater's average score, with the difference in ratings to the other 2 raters on a decile gradation here. And what you get as you move up the scale is the amount of disagreement in the ratings of a company across the 3 raters. This is a nice visualization of the difference between rating methodologies. And as the differences grow, as you move to the left and the right of the mean scores, you'll see that's the split. And that's interesting because what it does show is that there is eventually some strong agreement in ESG ratings, and that is regardless of the methodology, and that is who are the worst performers. So that top line, you'll see the biggest bump, those are the lowest scores. And they do seem to agree on who the worst is, but they don't necessarily agree on who the best is. A line here that you can take out of this is ESG measures from commonly used data providers neither provide information about systematic risk exposures nor exploitable mispricing. And that's what we're looking for in the capital markets. Next slide, please. So here's another link between the financial and the ESG ratings. So this time we're looking at ESG's top rated quintile minus the bottom rated ESG quintile. The top line in blue is for the ESG ratings. You get the 3 components. Environment is in yellow, the teal, the social, and G is the magenta. The silent S, you know, you can see it sort of lagged, but I think that's probably changed, and certainly we saw that happening through the pandemic. The most common global ESG investment approach is called a tilt, and this corresponds to negative and exclusionary screenings, or pretty simply what you have here is you buy the top percentile or quintile in ESG ratings from MSCI and sell the bottom. And there you can see what your performance would be on a portfolio of those. You also get, and I'll attach the paper and send it by Pastor et al. At 2021. where they documented that green returns are commonly the results of random shocks to ESG concerns. Those are the events that I was mentioning earlier, idiosyncratic risks. And they find little support for an ESG premium in expected returns. This is a growing consensus inside the investment world, and one that I've long advocated for. And it begins with a counterfactual on ROI, which is risk of inaction here that I talk about. ESG investing may not generate your cumulative abnormal returns, or alpha, as they're commonly called, but it will save you dollars. So good ESG doesn't mean that your company gets a premium, but poor ESG means that it'll be discounted vis-a-vis its peers. The next slide, please. ESG reporting standards have developed and matured over the last 5+ years. Sustainability first meant more reporting and more transparency, but now you get, like I said, reports of everything and everything. But now we've started to move beyond that. We're now at a point where reporting is expected, and we're talking about better strategy. Is the signal investment analysts, better strategy is a signal that investment analysts are sifting ESG data for to construct and support their financial narratives. For companies, this means increased investment in ESG expertise and intelligence. And this is from the mind phase to the corporate offices to the boardroom. The green bars here show the level of importance attached to ESG issues by institutional investors, and thus the more common materiality. You'll hear issues that raters assess. This is on a 5-point Likert scale, with 5 being extremely important. And you'll see that all 10 issues noted here are in the survey are firmly on the more important side of the divide. But just as miners face a range of ESG issues, location, commodity, regulation, and weight, so too does the investor community. They even differ on what the definition of ESG is. And it's why you see things like in Europe, the introduction of the FSDR, the SEC has come out with taxonomy, the ISSB that I mentioned earlier, and other standards are aligning behind TCFD. Investors examine ESG ratings methodologies, then they pick those most aligned with their needs and often with the data collection and aggregation that underpin their ratings. That's what they're interested in, not so much the top line. I know at Sustainalytics, that was one of the things that we got from clients was, yes, they were interested in our top line assessment, but they were also as equally interested in the data that went into coming up with that line. And then the blue line here on this chart is the level of consensus measured by standard deviation. And again, this here shows where there is some disagreement. I think you see the 2 largest spreads come in related to GHG emissions and energy efficiency. So this might be whether an institutional investor has an exclusion of fossil fuels or not. So methodologically speaking, ESG ratings are essentially a vector. They are a management times an exposure. That's usually how they work, and are some derivative of it. Industries with higher exposures to material ESG issues tend to score worse on average than firms with less exposure. Again, my old company, Sustainalytics, just released a paper on this that you can find on their website. And I would suggest you read that, and you'll know that the industrial conglomerates, mining, steel, forestry are 3 of those 5 most exposed and riskiest industries. Risks such as climate change can be systematic and have a distribution of outcomes that are unknowable and yet present material risks such as access to resources, human, natural, or capital, and also the vulnerability of infrastructure and ultimately on corporate valuations. Next slide, please. ESG and financial risks are commonly referred to as the double materiality. We heard the triple bottom line. This is the double materiality here. And that's an approach that considers both outside in, financial analysis, and inside out, impact analysis for assessing materiality. And again, this is something that's foundational in all ESG ratings, regardless of methodology of the company. The slide further links where the financial and ESG ratings is for investors and analysts, something that miners, I think, would do well to understand to help focus their ESG resource allocation. And you can see the top one there is value. But if we go all the way down those 10 categories, even at the bottom, the WAC, as I mentioned before, is more than 50% very important or quite important. Next slide. So this is where I'll conclude. What was once voluntary is increasingly becoming mandatory. The convergence of environmental, social, and corporate governance standards, metrics, and taxonomies with financial risks is accelerating. This just scratches the surface of the topic. It's pretty deep. Coming from debt capital markets, as I mentioned, I'm embarrassed to say that I haven't even touched on that side of the corporate cost structure, the bond side. Sustainable linked bonds, green and blue bonds, and where the financials are for debt investors, and they have a different view on where ESG issues come up. For the mining executives and others that are engaged with them, I'll leave you with this little bit of wisdom for your ESG journeys, and this is something that Pauline just referred to in her opening, and that is, you cannot talk your way out of something you behaved your way into. So thank you, Sarah. Thank you, Rose, for inviting me. Thanks for your time, and I look forward to the ensuing conversation.
Amazing. Thank you so much, Michael. Wise words, especially at the moment. You cannot talk your way out of something that you behaved your way into. Massive round of applause. Fantastic. Great. So we've got a number of questions coming in, but actually I'm going to bring Ludovine to the stage because she's been very active on the messaging behind the scenes. And instead of me just looking incredibly intelligent by asking you her questions, why doesn't Ludovine come to the stage and speak herself? On you go, Ludovine.
No, this is an ongoing conversation between all of us. Michael, thank you so much for this presentation. It's so packed of information. One of the things that I'm most interested in right now is, yes, there's a lot of criticism of ESG ratings, but in reality, I mean, is there also within the ESG rating universe a debate about the value of the data versus, the value of its use? This data is produced because people buy it. The users and the buyers of this data have shaped the offering. I'm really interested to think about how we change their, search for information. And is that something that you're seeing as part of the discussion, both on ratings, but also on the standards and frameworks you alluded to previously? Or are we not there yet?
So that's a good question, and it's a deep one. And yes, and both are separate, though there is an overlap. Certainly on the ESG rating side, the aggregators, essentially that's what they are, is aggregating data. This is your indicators, and XYZ rating company uses 138 indicators. These ones have 700. This one has 38 per materiality. So this is where I mentioned that it's sort of like a vector. You have an exposure, and that's assessed based off of number of indicators, and that's going to be based off of qualitative and quantitative. So some of these things are fairly easy to find out. How many women sit on your board, for instance. That's a fairly easily quantifiable. The social license to operate, your community relations, that's a little bit more difficult to put a finger on and assess numerically, though that's what they try to do, or we take account of it. So definitely there is the sourcing of the data. All of it is publicly available, and you're starting to see increased amounts of alternate data. So things coming from CSOs and NGOs. Transparency International, for instance, is something that I looked at. I did the tailings indicator when I was at Sustainalytics, or my team did, and we looked at data that was provided by RMI, by ICMM, by MAC, by IRMA, and started to hierarchically rank the efficacy of their membership and their reporting as a member. For your other question on ESG, and I'm just trying to remember where this. So the discussions on how it's used, that is the methodological difference, and I don't think that's ever going to change. And even people are saying, well, the ESG ratings don't look like the credit ratings do. But I can talk to Moody's and S&P on the same country and get a different point of view. And they're using auditable financial data. That's where these standards are going towards. And this is something that the ISSB is looking at, because saying there is the penalty for, not necessarily a penalty. It's always been, well, if you don't report, what happens? Yes, the market might slap you on the wrist, but plenty of companies have turned a blind eye to that. Where the ISSB is interesting, at least from my perspective, is because it's attached to IFRS and accounting standards across the IFRS membership. And that is that these standards are going to have to be included by your auditors. And so if you don't have the data to supply to the auditors, then they can't sign off on your audit. Now, that is something that is not going to go over very well with the capital markets, because it has to be signed off by the auditor. So that's where I think it's a bit of the carrot and the stick that's going on here. And hopefully the carrot is you're going to be auditable, and therefore we have greater understanding and confidence in what's being reported. And therefore that's will allow us to make better decisions, both at the investment side, but also in the engagement with and the community relations that Pauline was talking about, the community relations back to the company, so that you can have these conversations with the company and say, okay, here's where you're doing well. As you saw sort of in that chart with the 3 ratings differences, the ones who are doing bad, everybody agrees on. It's how good you're doing becomes a little bit more diverse in what each individual ESG risk rating is measuring.
So with that, Michael, just one thing in terms of whether you're doing good or whether you're doing bad, or whether you're doing well or if you're doing poorly. I guess that means, again, what are you measuring against? Are we just talking about risk to financial things, or are we talking about risk to natural capital, social capital? And this then perhaps comes back to a lot of what we've been discussing over the week, is actually, what are we trying to create here? Are we just trying to make money in the same way that we've always done? Or are we trying to actually go through this step change in terms of a transition, etc.?
So this is the point where I said I wanted to plant the flag, because ESG is not a panacea.
Yeah.
It's and from my perspective, which is sort of horse collar or blinders on, it is for the primary users of financial reporting. Yes, there's the hope that it does this and you're going to get better at that and greener this, and that's great. That's the hypothesis. But at the end of the day, it's for those that are making financial decisions, whether it's investing their capital. And it depends. Like I said, there's some that are strictly fundamental, and there are impact investors. So they are looking at and pulling out the different data, and depending on the companies that they're looking at, they're going to have different use cases of the ESG rating. So everybody's trying to make money, or in essence, generate the impact, and the impact will be felt by, they relate it back to justifying the investment. So if it's, I'll put in $1 million, but I want to see education to the community, then how you measure education to the community is the thread via ESG ratings and or the indicators back to that $1 million. And if you didn't educate the whole community, then the $1 million, the investment didn't work, or didn't work fully. So that's, I think, the line and the thread. We're trying to bring everything back via ESG ratings to dollars and cents. That's how we equate things. I think it was Coolidge who said that everything comes back to the economy, because that's how we value things today, so that we know what to invest in for tomorrow.
Okay, thank you so much for that, Michael. I think this is something as well to explore, because certainly with things like TCFD, so the Task Force for Climate Related Financial Disclosure, the thing that often surprises people is We're not measuring climate, we're measuring the risk on finance that is posed by the climate. And it's almost the same kind of thing here with the ESG ratings. We're not actually talking about ESG in the way that perhaps an ESG specialist might talk about it. We're talking again about that linkage with money. And so organizations who think, hey, we're going after a really good score in our ESG ratings aren't necessarily going after the best ESG, or there's, you know, different interpretations there. So awesome. Thank you so much, Michael. Absolutely brilliant. As always, thank you so much for joining us. Massive round of applause. Brilliant.